I think one of the, in my opinion, greatest inventions in financial world is the invention of these ETFs. These ETFs are ways for you to invest into the global market without, paying through your neck. Right? And instead of paying 1.5%, 2%, you can buy S&P 500 at now less than 5 basis points or 0.05%, which is incredible because you're getting access to the, when I say S&P 500 means you're investing into the, top 500 companies of the world, and you're paying 0.05% to invest into them, right? And you're getting instantly, diversified access to these top companies.
Okay, welcome to a new episode of Chai Pe Kharcha. We have a very unique guest this time around. We have Ritesh Ganeriwal. Ritesh, to start with, can I ask you to introduce yourself, give a brief introduction on how you became an NRI, how long you've been an NRI?
Sure. I said, thanks for having me in the show. Very excited to be here. I'm Ritesh. So I landed in Singapore back in 2014. This was basically, so now it's almost like 10 years, like more than 10 years since I've been here. But back then I entered as an intern because I was doing my master's or MBA in the US at Chicago booth. And even though I was doing my master's there, the intent was really to do the master's and come back to this part of the world. And when I was evaluating where to, look for opportunities post my MBA, I was kind of like narrowing it down between Hong Kong, Singapore, and of course India as well. But given that, MBA costs are really high, you obviously, try to locate yourself in these parts of the region where you can kind of like make sure that your loans, etc., that you've taken, you can, manage that, and you can also grow your wealth and sustain yourself as well. So in terms of my journey, before starting my international leg, which was 2014 in Singapore, I was out of India 2011. So that was my first kind of like proper foray out of India, where I did a small stint within Morgan Stanley. I was working at Morgan Stanley before I did my master's. So the master's was 2013 through 15. So those were the 2 years where I did my MBA in Chicago. Before that, I did a small stint with Morgan Stanley in New York, and that really had opened my eyes into the broader world that exists beyond India and beyond, Mumbai, where my professional career was kickstarted. So I graduated with Spilani in 2006, and then joined Morgan Stanley straight out of from 2007. Initially as a technologist, so I was a full-fledged code developer. But I think the good thing with me being at Morgan Stanley was I was aligned to one of the business divisions and learned quite a bit in terms of core financial product. And that really piqued my interest into going further and learning about the and proper setup and all. So 2007 through 13, I was at Morgan Stanley with a stint in New York. And that opened my horizon, did my MBA. Post MBA, I wanted to be back in this part of the world. So that's how I landed up in Singapore with an internship at Goldman Sachs and converted it and then landed up in Singapore and grew my career since then. So it's been 10 years living in Singapore.
Got it. All right, this is quite an interesting journey. And the first question that pops up is, why Singapore? So you were doing your MBA in the US.
Mm.
What was it in Singapore or Hong Kong, as you mentioned, that attracted you here as a destination?
Yeah, so look, when it comes to my key domains that I was interested in finance, right? And before joining my MBA, I was at Morgan Stanley, as I said. I was more on the institutional side. I looked at market risk, and I'm one who was managing, money for other people. So investment management was a key domain that I wanted to focus on. And then when I was looking out for opportunities, obviously people who go to the US and spend so much, time, effort, money, they tend to stay there for a few years and build their careers. And then, they think if they want to come back and all. But for me, essentially a combination of reasons from personal to, professional in terms of, where I want to build my long-term career and, be close to, my parents, etc. and all. So kind of like zoned into Singapore and Hong Kong because these are the two financial hubs in the Asian context. And within the two, what ended up happening was pretty, interesting because the funny story is the MBA that I went to, actually, I was already married back then. And both me and my wife had applied for this MBA together and both got into the same school. So essentially, we were both hunting for job opportunities in this part of the world. And what ended up happening was she got an opportunity in Hong Kong. I got an opportunity with Goldman in Singapore. And yeah, I mean, like, we, commuted, did long distance for a while and eventually decided to, settle down in Singapore.
So let me ask a follow up on the same question,
Mhm.
where how has your perspective changed from a personal finance lens?
I think India typically, again, when we started or I started my, professional journey, etc. and all, the only thing that we knew was, okay, invest in mutual funds and do SIP. And I think that's great. I think from a perspective of being in India and having some disciplined investment strategy, getting that aspect of SIP done on a regular basis actually is really, really good. It is kind of like embedded in more or less, every, person, which is in fact like great in my opinion, because not a lot of people are financially literate, in my opinion. But literate in the sense that, like, they don't know what exactly to buy and how much to buy and what proportion to buy. And of course, Indian market is very, very dynamic as well. It is one of the, biggest stock exchanges in the world. People love to trade individual stocks in India as well. Again, with, limited success, I would say. But the whole concept of SIP is something that I think it is very, good and kind of like now very, 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 very well embedded into the Indian ecosystem. When it comes to, moving outside of India, obviously your perspective changes again a lot. Your needs change, your, capacity changes, etc. and all too. Back in India, you were earning, you were saving on a regular basis, and then, straightforward, you just put some money into mutual funds, right? Like, that was how I used to deal with it. Of course, while living in India, buying real estate was a pretty big thing. Like, that's an Asian thing as well, that, you buy your first house and, like, you save for it and, like, how you can, get that first house, your first car, etc. And then are some of the key milestones that everyone, wants to achieve. And I kind of like, also went through that journey, bought my first apartment when I was in Mumbai. And this was huge because, like, in Mumbai, real estate is really expensive. Back then, I remember, I took a loan of some 50 lakhs. At that time, I was like, oh shit, like, this seems a bit too high a loan amount. And I had just started my career like 3, 4 years back and on. But, that whole thing about, like, real estate, like this, call something that is yours. So went for it and basically, thankfully, the job was okay, kept on going well. So what met though was essentially on a monthly basis, you have living in Mumbai, there's a decent amount of, EMI that you're paying. But beyond that, and, the utilities and the household, stuff and all, the rest of the things were then savings and to a certain extent investing. So that's how life was back in India. As soon as you move out of India and into the international sphere as well, you start to think about dollar wealth versus rupee wealth. And when you start thinking about dollar wealth, you realize that you're so far behind, right? And you need to still earn so much, it grows so much, etc. And for me, the reality was my net worth was going to go down because I was going to leave my well-paying job. My wife was going to leave a well-paying job. And we were both going to take huge amounts of loans to do our MBA for 2 years, no job, do MBA, take pretty hefty loans and then rebuild your wealth and hopefully rebuild your wealth dollar terms. And what that means is then you need to have justifiable salaries, etc., to first pay off those loans and then figure out how do you invest. Because as I transition out of India, then the whole focus was, oh shit, now I have to be super cautious about spending money. And on one side, I had a EMI that I still need to service, right? So that EMI does not go away. But then there is the student loan that I've taken on top of it. Yeah, I mean, like, the 2 years MBA is obviously like, was a good amount of fun, a lot of, great peer group, etc. and all. But by the end of it, we're in heavy debt, right? So that's the, end state after the MBA. And that meant that like, how you choose your, jobs, etc. will again play a key role in terms of rebuilding your wealth from there onwards.
Acha, let's come to a question that would be very connected to the roles you have played within the finance companies that you have been part of.
Mhm.
What are some of the common mistakes that you see people making in making financial decisions? And if you could answer it from a perspective of an NRI, that would be awesome.
Sure. I think first and foremost, even as NRIs, we, tend to think that we are great stock pickers. And I think that's the biggest mistake that I've seen people do, where they, try to pick individual stocks and try to get the multi-baggers, etc., versus having a more disciplined strategy. So the principles that we learned from India of SIP investing, I think that SIP investing is something that I would heavily, heavily encourage everyone to follow through when it comes to investing globally as well. And I think the second part is like, we tend to think a lot that when it comes to investing, it's the earlier you start investing, the better. And we always try to delay it, saying that, okay, maybe not important right now, right? I will think about investing seriously next year or the year after. And that I think is something that heavily impacts you, because the earlier that you can start your investment journey, that is the extra amount of time that you give for your money to compound. Just a 5-year delay can, reduce the amount that you can actually make by more than 100, $200,000, right? Like, depending on how much you're contributing. So if you are someone who, starts at 30 versus starts at like, 25, you know, the results will be very different compared to, when both the people reach the age of 40, for example, right? So I think starting early, one of the key advices that I'll give for people. Number two, having a more index oriented long-term investment strategy, which is the base of, your investment. That is the second advice to begin with. So if you've got $100,000 to invest, make sure 80,000 of it is in an index, right? Like, an S&P 500 or something like that. That would be the starting points of, how you start about or how you think about investing in general. Um, I think the other mistake from NRI perspective that I've seen a lot is sending too much money back to India. Uh, so I think when it comes to anyone who's an NRI, now that you are an NRI, it is important that you build your dollar wealth, right? And yes, Indian market is, done really, fabulous. And from an INR perspective, you would have gotten double-digit returns. All of that is great. But what I think people need to understand is what is their, dollar return when it comes to INR. It gets eroded away because, US dollar appreciates against Indian rupee. And then you end up making roughly almost similar or even potentially lower compared to what you will make if you invested into S&P 500 over the course of the same period. And then you would have made your dollar wealth grow. I think it is good to send some money to it, depending on what your needs are in person. But beyond that, it becomes a little over the top, in my opinion, because you end up having to deal with all the hassles of repatriating it in and then repatriating it back if you do need it here as well. For me, for example, if you have roughly between 1 to 3 years parked in India, I think even if you just put it in fixed deposit, that at currently, I think 7% sort of get on fixed deposit. So you got 2 CR or 1.5 CR. So you can easily generate 10 to 12 lakh per year, so per month. So if that is something that you need to help out with family, etc., and maintenance of stuff within India and all, I think that's more than sufficient. If you're making trips down to India, even that can be addressed with that kind of money that you're generating. Anything beyond that, I don't think you need to allocate from an India perspective. You should invest from a global perspective, diversify, and then hold it to grow your dollar wealth, as I said. And yeah, don't put any amount beyond what you would need from a temporary perspective. And even if emergent you need to go back, I think having an amount between those two numbers should be decent enough for you to restart and kickstart your journey back in India. And then you can see if you want to bring back other capital as needed.
So the 3 points are people generally don't invest in index. They should think about how much they want to repatriate back to India. And the third is
Starting early.
starting early. Acha, I have a question regarding the repatriation piece, because we've had so many episodes and we've discussed this so many times. So there is the theory that you mentioned where basically dollar depreciation होता है, rupee depreciation होता है. So don't send too much, only maintenance work. And then there is this counter theory, especially from a lot of advisors that we've had as guests who are in India, who are based in India. ये है कि now the market is pretty good. It has been pretty good for 6-7 years. But even if it is not good, generally the returns that you'd expect from India is 12 to 15%.
Correct.
On average. Right now, it's 20-25% तक आ रहा है. Okay? And if you invest in Singapore or in US, most Western markets, you'll get a return of 5 to 7% on average. You can get more with specific instruments, but 5 to 7% is their quote. तो वो बोलते हैं कि अगर 5 से 7% मिल रहा है और ये डेप्रीशिएट यहाँ 12 से 15 मिल डेप्रीशिएट भी हो गया 3-4% होगा, still you're getting a higher return in India. So why not send more in India, invest more in India? You have a rebuttal on that?
Yeah, no, Nick, I think obviously it's a fair argument, but at the same time, as I stand right now as a global citizen, right, I want to diversify my risk, right? And I will diversify it even, at the expense of giving up some returns, right? And the risks that entail is if I have too much money sitting in India and I really need that money for some reason, it's just too much hassle for me to, go back and not go back, but just to, get it back, even though it's in an NRI account per se, right? India, when it comes to the returns, yes, 12 to 15%, true. Never say never, right? Something specific could happen in India, right? You don't know what can happen. And if there is any, untoward events, etc., that event risk and the specific risk of India, you don't want that to derail you completely, right? So yes, if you are locally based in India, everything is in Indian rupee. If the economy falls, everything else falls, you are in a way hedged naturally being there. But based out of, Singapore or globally, you need to, take into account your other needs, etc., which might not align directly with the Indian economy and how it evolves and which years it does well, doesn't do well, etc. So there is that risk that, if something bad happens, then I would suffer a lot from a return perspective. I lose liquidity because I don't want to convert that money back at that juncture as well. Versus if I'm here in Singapore and I have liquid money and I'm invested in the global market, yes, the global economies and stuff like that goes down, I understand. But again, it is diversified and which ensures that, even if something does take a hit from a small duration standpoint, there are ways for it to bounce back, and it is money which is liquid in US dollar or Sing dollar terms, which can, still help me to take care of emergency needs, etc., and all as well. So that's how I would think about it, where yes, potentially India will still generate me that extra 3% return, but I'm, willing to give up that return in exchange of, being more peace of mind.
Got it. Fair point. Acha. So now that you've spoken about having funds or investing globally to diversify risk, question on that, as an NRI who's not from the finance industry, if he or she wants to invest in the global market, how how do you manage that? And this is a basic question, but answer it sometime.
Yeah, no, absolutely. I think, like as I said earlier, right, the simplest thing for anyone who new to investing is to, just pick up one of the big broad-based indices, right? Like, an S&P 500 or an MSCI World. If someone is a little bit more like, oh, I want to invest into the tech companies, etc. and all, take QQQ, which is like, NASDAQ 100, and start putting in, regular amounts into those indices, right? You will start to get a flavor of, investing. You will start to see the market going ups and downs, your, money moving up and down and all as well. At the same time, if there is a big market crash, your, thing will go down and all as well. But not like, an individual stock that crashes like, 50, 60%. So I think anyone who's just kickstarting their journey, the right way to kickstart is to just a broad-based index and start with monthly contribution, right? Like, that's how I would kickstart my journey.
तो even more basic रितेश कि यहाँ पे लोगों को पता नहीं प्लेटफॉर्म भी कौन सा यूज कर so if you could and I know there'll be a bias because you represent one of them.
Sure.
But when NRI is trying to evaluate the, I have to choose a platform, I don't know anything.
Sure.
Bank mein karte the. Now I have to come here, I have to figure out the, even the index funds in the US, like you mentioned, QQQ, yeah, S&P 500. So these are US funds. But are the index funds in the US the best way to go as compared to Singapore's index fund or somewhere else?
Sure.
So even those basic decisions, how does one make?
Yeah. I think to begin with, obviously in Singapore, people are spoiled with choice. And, now it is almost confusing because there are so many choices, right? Now, when it comes to different investment platforms, the way to think about it is obviously there are the banks, and each of the banks, they have ways for you to invest through the banks. Typically, the banks don't make it very easy for people to invest into the market in affordable manners, right? So when I say affordable manners, in the sense that efficient, affordable manner, I think that's something that all of us do value. That like I want to invest into the market, but not by like paying hefty fees, which I don't know why I'm paying, etc. and all. But typically at the banks, you will end up seeing a lot of like mutual fund based offerings. And I think again, coming from India, mutual funds is, something that we are all very used to and like, we appreciate, etc. and all as well. But now as people become more sophisticated and learn more about mutual funds, there are different kinds of mutual funds. There are mutual funds which are very active in nature, meaning that like, you pay 1.5-2% annual management fee for these mutual funds. And when it comes to international and global market, you said as well, right? Like, the general expectation is you make, high single digit returns, right? Like, between 5 to 10%, but more like, 6, 7%. It's what people typically, tend to make. And if out of that 6, 7%, you give up 2% in just, management fee, then that's a huge leakage. But typically, most of the banks will offer you a lot of these mutual funds. And even if you go online and all, these are the first things that you will notice. And then on top of that, I think it is not just that, right? Like, the RMs will call and they will call you these, and they will also take upfront sales charges. So it is the 2% management fee, but on top of that, you're paying, entry level fees, which is, between, depending on like how you do it, but it can, as much as 3 to 5%, right? And, like that, typically a lot of people who are not so much knowledgeable about investment have never, thought about it and all. And RM calls and tells them, oh, this is a great fund managed by XYZ and good track record, etc. and all. Sometimes we do get, swayed and we will buy into these funds. But then we will also lose a lot of, I think, trust the investment over time, because what you realize is like, upfront, because that 3% is gone, you start at a loss. And then like, if market doesn't do well, and even if the market does decently okay, there is so much fee leakage, you don't tend to see your money grow. And that makes you lose a little bit of confidence of, oh, these investments are not going to give me anything. I'd rather keep my money safe in the bank and do nothing. So I think that's the, starting point. And that's where I think like, a lot of investment platforms are born, especially, the digital investment platforms such as us, where we are trying to democratize investments. We are trying to make it, affordable. We are trying to make it, more democratic. And I think one of the, in my opinion, greatest inventions in financial world is the invention of these ETFs. And these ETFs are ways for you to invest into the global market without, paying through your neck. Right? And instead of paying 1.5%, 2%, you can buy S&P 500 at now less than 5 basis points or 0.05%, which is incredible because like, you're getting access to the, when I say S&P 500, S&P 500 means you're investing into the, top 500 companies of the world, and you're paying 0.05% to invest into them, right? And you're getting instantly, diversified access to these top companies. So I think, platforms such as us, what we do is instead of trying to make money through, these mutual funds and, sales charges, etc., scalable platforms. And the idea is like, as people join the platform and it becomes big enough, we will also charge some management fee. But, the idea is like, the management fee will be so tiny that it won't really, make a dent in your pocket. And we will make money when, sufficient scale happens and all as well. So, whether it is SAIF, when it comes to more of a, investing into ETFs, I think SAIF is one of the leading houses when it comes to, that sort of domain. Of course, all the brokerage platforms, right? So there are different kinds of brokerage platforms available. So especially if you are someone who wants to buy these by yourself and identify them, whether individual stocks, I want to buy a Tesla stock, Apple stock, or these indexes, etc., and all as well. The cheapest platforms are like, say SAIF, there is interactive brokers, of course, a couple of Chinese, brokers, which are also very, very cheap, like Momo, Tiger, and all as well. And I think on top of that, then there are, the other more sophisticated platforms like, Saxo, etc., more expensive. There are the age old, like, Singapore brokerage houses and all as well. But typically, again, their costs are, much higher. And then the banks, of course, at another level. So there is this whole range of, brokerage platforms through which you can invest. I think, if you choose between, IBKR, SAIF, and one of the, more recognized name, you should be okay in terms of, kickstarting your investment journey, and especially into ETF investing and all. Now, I mean, we can go into the other part of it, which you had asked in terms of, oh, do we invest into the US ETFs, Singapore listed ETFs, or, should we look at some completely different ETFs? And I think that's a great question. I think when it comes to US investing, one thing that people often, don't know, and again, someone who's new to investing, they don't understand, is there are a few different taxes that you might be, subject to. So the first and foremost is the dividend withholding tax. So if you're investing into US securities and if there is dividend getting paid, the dividend will get taxed at 30% at source, meaning that like, if you invested $100, you got $1 of dividend, out of that $1, 30 cents will be taken away. You will only get 70 cents, you will not get the full $1. But important to note, it is only on the dividends, not on the capital gains. So if that 100 becomes 110, that $10, no tax. But if that 100, you get $1 of dividend, that 30% gets taxed. Now, one way to kind of like mitigate this is, and not totally mitigate, not possible to totally mitigate it, but there are certain ETFs which are listed in Europe, Irish domicile ETFs. These are called Irish domicile ETFs, and Ireland has a special treaty with the US, meaning that the dividend withholding tax goes down from 30% to 15%. And this is for the US security. So if you are trying to invest, for example, in S&P 500, instead of investing into S&P 500 to a US listed ETF, if you invest into S&P 500 through London listed ETF, which is Irish domicile, you will, or you have the capacity to save 15% out of the 30% withholding tax, right? So CSPX is an alternative. So instead of investing into things like VOO, SPY, you can look at CS, because CSPX is listed in London. And, it is basically, something that will save you 15% dividend withholding tax. Of course, I think just the dividend withholding tax is not the only reason. So that's something that, again, people need to be cognizant of. There is a lot of nuances when it comes to investing. And again, I think I'm going a little bit technical here, but suppose there is an ETF which is in the US, and it has, there is an equivalent ETF which is in London, Irish domicile, and it saves you 15% withholding tax. But the expense ratio of this listed is higher, or the management fee is higher than the US listed, right? So it is possible that, the withholding tax that you save, you actually give away part of that, cost saving because of extra management fee that you're paying. The other thing is these ETFs, because they are listed, they have a bid offer spread. When you, buy or sell, they have two prices. And typically when you buy, you get the, ask price. And because of the spread between the bid and ask, you might incur a higher kind of transaction fee or spread fee, which will be much more tighter in the US market, because it is very, very liquid there. So that can also, reduce the amount of return that you generate from the London listed versus the US listed. Of course, what happens is the transaction cost is a one-time cost. If you buy and hold it and then, hold it for years, then there is no ongoing transaction cost, right? So, of course, some of these are also super nuanced, but there are pros and cons of, buying things from the US market versus, the London market. So I think beyond some of the more liquid indices that I'm talking about, you might be better off investing into the US market through the US ETFs sometimes. Or, especially the individual stocks, there is no way for you to buy into those individual stocks in another market, right? So you buy directly in the US. I think the other part is, the inheritance tax. So, if, for example, you hold these securities under your own name, then beyond a certain amount, I think it is 70K US, there is an estate tax that is applicable. If, something happens to you as an individual, then, someone else takes over, then there is a 40%, I think, estate tax that becomes applicable and all as well. Now, again, while that is applicable, myself still hold all my US securities, in the US listed, space and all, because essentially, that's the most efficient way for you to get exposure to the US market. And as of now, from an access standpoint and all, I ensure that, people who should know, these know about such that, if there is any emergency, we can, get, keep that access and not be subjected to those, estate taxes, etc. and all as well. But again, these are things that become important, especially if you've got like $1 million, $2 million of, portfolio. You might want to consider setting up a trust. And if you set up a trust, then what happens is, the trust becomes ever living kind of, entity. So, saves you from, or, reduces the burdens such as the state taxes, etc. and all as well. And I think getting too complicated here, a couple of things, to note. To begin with, if someone is again looking to invest into the US market and to get access to the, most liquid indices and all, I think especially S&P 500, NASDAQ, etc., you can get those accesses through, London Exchange. Individual stocks, I would say you would still need to go to the US.
Got it. Yeah, indeed, actually, it got very complicated. इतनी सारी चीजें. This is the end of part 1 of the episode. We will continue next week with part 2. Thank you for listening in and stay tuned.